Get your cash out now. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major bank faces imminent collapse. And I want to show you who this bank is and why it was inevitable they were going to be in this situation. The challenge we're facing is they're going to be the first of many more banks that go down. And this is all on the back of what will be known as one of the biggest policy mistakes in central bank history. I'm going to show you how this mistake is already manifesting in another country and why, when it gets here, the Fed will be powerless to stop all the banks that are about to fail. Now let's head over to Bloomberg, where he picked today's story up with a headline: New York Community Bank flags weakness in loan oversight and now names a new CEO. And you know things are bad when you get a new executive at the top. It tells you as this bank continues to see a stock outright crash. At the time of recording, now down 25% from already a big drop over the past several weeks. It tells you there are further problems here, and this is only going to get worse as they start digging deep into the bank's books. The weakness is related to internal loan review resulting from ineffective oversight, risk assessment, and monitoring activities. And you can get where this comes from, because in a normal economy, when things are expanding, yes, there's going to be some bad loans. There's going to be some mistakes. There's going to be errors made. And what happens is, because the economy usually is running so well, that a couple loans go bad, but it's not a big deal. Or maybe they get refied later on into a new loan. So all of that bad stuff gets covered up. But when you're in a slowing economy driven by massive inversions by central bankers across the yield curves and money curves, what happens is the rot starts to show up in a big way. And next thing you know, you find out your bank is sitting on a lot of garbage, including cash that you need to get out. As it separately took a $2.4 billion goodwill impairment tied to past transactions, which won't affect its regulatory capital, because the issue here is it's only a matter of time before we see New York Community Bank face perhaps receivership. Maybe their stock goes to zero, and what will happen is savers will want their money out in the worst possible way. And the situation, if you think this is getting better, no, it's only going to get a whole lot worse, because when you constrict the creation of credit in a debt-based economy, well, that means the number of loans that banks originate go down in a big way, and that leads to exactly what we're seeing with New York Community Bank. Is all of a sudden they're finding out they've got far more bad loans than they thought they had, and they really just don't want people to know that the bank is on the brink of failure. And here we can see the commercial industrial loans on all commercial banks. It's on a weekly basis, looking back from a year ago, against the delinquency rate on all loans of commercial banks. That's shown in red. And what makes sense here, when central bankers invert these yield curve and money curves, the banks can't make money lending. So what happens is they start to see a deceleration in the loans they issue. And what happens, that leads to a corresponding increase in delinquencies. And you can see they line up almost exactly together as, of course, loan growth slows, delinquency rates rise, because in a debt-based economy, you typically see an old loan get paid off when the new loan. So if there's something bad going on, well, maybe a new person comes in, refinances a loan, maybe something in the business changes, maybe a company gets bought out, and it's not unusual to see this happen. But in a time where you're seeing a slowdown in the economy and banks aren't creating enough new loans to support, of course, the expansion of the economy, what you start to find out is that all of these loans that you thought were good start to turn bad in a big way. And sure enough, we see that starting to begin now. We don't have the latest data because this is only updated quarterly on the delinquency rate, but you can only imagine, as commercial industrial lending now remains in contraction, that we're going to see an increase in delinquency rate, because there isn't enough money to support all of the growth objectives for the economy, the targets we have, and to pay on all the existing debt. Something has to give, what usually means if you constrict credit enough, you sacrifice growth, and you end up seeing a lot of delinquencies that turn into defaults, and that's exactly what we're seeing now happen at New York Community Bank. And we can cite this exactly because of what these central elites have done. As we look now at the yield curve showing the 10-year minus the 2-year, and when you see it inverted, that red line below the horizontal black line, that means 2-year yields are higher than 10-year, and this is not normal for the economy. This is man's, inverting the curve by stepping in and knowing more than the bond market here. And what do you see is when the curve steepens, that happens when rates fall. What then correspondingly happens is you'll notice that the path down in this commercial industrial lane gets worse. So a lot of people think, well, if the Fed just cuts rates, or if these central bankers just cut rates a little bit and bring the curve back into the normal pattern where short-term rates are lower than long-term rates, everything works out. Well, history shows us that isn't true at all. In fact, what it says for banks like New York Community Bank, it's only going to get worse. And what that's going to lead to is exposing the rot in a lot of other banks all over the country and perhaps even the world, setting off not just a globally synchronized recession, but at the same time, a banking-led financial crisis. The announcement reignites a drama that erupted at the end of January when the company, a major lender in New York apartment landlords, said it's stockpiling cash to cover potential problems with loans. And that's exactly, again, what happens when you constrict the creation of credit. You start to run out of money to support the economy, support the payment of loans, and next thing you know, banks need to start hoarding cash because they're worried about insolvencies. As investors in regional banks now have been on the edge ever since, focused on whether multifamily residential complexes can generate enough revenue to maintain financing after the state of New York toughened rent controls back in 2019. And of course, one thing that shouldn't be reigniting drama is your trading account. We make trading so easy. My friends, over the last 2 weeks, I put out videos almost every day with our signals on both of our reports. We've had a bunch of fantastic signals to help you make money trading. And let me just show you how easy it is, because on our CTA Timer Pro, we look at the machine position. You've seen this before, and we run historical overlay to show you these extreme positionings. And then on page 1, every day, we show you when these signals goes off a deep short and start covering. And then I put out a video showing you how to trade it step by step. There are 3 coupon codes right now for each report for a free month. And then if you're trading the technicals, you find that what happens is you get into the market late and out of the trade too early. We add one variable that no one else uses with our technical signals, and what it does is smooths it all out, makes it so easy. Here you can see back on October 9th, what did we flag? Signals both on our CTA and Momentum Timer Pro for QQQ. And notably, if you would have bought it open here, you'd be at 22.39%. And this week, we put out a whole bunch of trade signals. We're making trading so easy for you, so stress-free. All you have to do is tune in every day as a subscriber, see the signals, watch the video, and place your trades accordingly. Again, links in the description below for a free month for each report for 3 lucky people. Without a doubt, the situation feels a bit uncertain at New York Community Bank right now. It should feel that way, and depositors should be concerned because we fear there could be additional issues that get raised as a new team takes the reins. What that simply means, as new people come in and take over those old positions, where they're going to find out where all the cover-up really is, and they're going to be outright shocked to find out that the situation at these small and mid-sized regional banks is far worse than most people, including the Federal Reserve, wants to admit. And we note that, as we talked about in the show the other day, the Bank Term Funding Program is still maxed out and now closed. That deal is going away here in March. Banks aren't touching it anymore, suggesting that we're about to see chaos begin, because what happens in March? The banks have to start paying those loans back they took a year ago, and watch out. We know they don't have the cash, because one risk that credit costs could be higher for longer as internal oversight is fixed. That won't save it. This, of course, from the analyst at Raymond James, Steve Moss, said the credit costs, you can lower them, as I made the case. That isn't going to fix the issue here. In fact, it's going to make it worse because lower rates lead to tighter financial conditions. So if you see rates start to fall, that means the banks are going to lend even less at this point. That's dangerous because then you see a further contraction in commercial industrial lending. Why that's key is because when you make a principal payment back on a commercial industrial loan, the money is destroyed to the financial system. So here we have the case where we're not only just not creating enough money to sustain the growth and debt of the economy, we're simultaneously destroying money. This is a dangerous situation. And as you'll see by the end of the show, central bankers, this puts them in the worst case scenario. It's already starting in another country. And it won't be long before it's here because the new CEO was appointed as the executive chairman early in February to help the bank, and now as of today he's taken over operations. He's a former head of Flagstar, and that was joined New York Community Bank when it was acquired, that firm, back in December 2022. We'll say he's got his work cut out for him because we're seeing defaults. It's not, again, just here in the U.S. It's going to be a U.S. banking issue. This is going to be a global issue. We've noted this as a problem in Germany starting to surface, but how about this? Look at this in Sweden as defaults surge, marking the worst February since 1994. That was the year I graduated high school, if you can imagine. Now 902 firms went bankrupt, which is wild. Now granted, this tends to fluctuate seasonally, but one thing you cannot fluctuate seasonally against is a number going back to 1994. That is outright wild to see this many bankruptcies. And of course, this is the largest increase and was recorded among hotels and restaurants. There's your discretionary side of the economy that everyone says on the services side is going to boom, followed by consultancy firms and companies in the construction industry. Of course, it makes sense when banks aren't lending. Again, this all comes back to demand in the global economy. When you constrict the creation of credit, demand has to come down. This is why the consumer price index, the personal consumption expenditures, all those things come down because you constrict the amount of money in the economy, demand falls. Next thing you know, you start to see delinquencies. Those delinquencies turn into defaults. So you get bankruptcies. This is all just part of exactly how the cycle is going to go, and it's not at the end. This is just the beginning, as the Nordics region's largest country has seen its economy weaken following an 18-month-long campaign of monetary policy tightening. There's rapidly increased costs for mortgage borrowers who often have rates fixed on short-term loans. Now, we talk about these lags in the monetary policy. You hear this from, Fed Chair Jerome Powell and other Fed chiefs, that there are variable and long lags in monetary policy, which translates to we really don't know how this is going to play out, but at some point things start to go wrong, and you're really starting to see this happen now. We thought back a year ago in March things were looking pretty bad. There was just enough to cover that disaster up in the U.S. banking system, but now look, we see around the world more and more problems, and this is setting up, again, the worst case scenario for central bankers, as you'll see here in a bit. Combined with high inflation that has weighed on consumer demand and led to a near standstill in housing construction. Again, as demand goes away, do you know what goes with it? Well, if you're thinking jobs, you got it right. As the ECB is cutting too soon would be worse than delaying, according to a survey. No, what would be worse is sending the global economy into a synchronized recession and all-out financial crisis, because these central bankers have absolutely no clue what they're actually doing. The ECB has a trade-off between cutting too soon and risking a resurgence in inflation, which wouldn't be a big deal because demand continues to fall, and potentially having to raise rates again versus cutting too late. Again, I made the case, we talk about cutting too late. That isn't the issue, because by the time the Fed starts to cut, it's game over. And as we saw in that prior chart, we see a decrease in interest rates does not lead to a resurgence in lending. It's just too late at this point. And here we can see the latter is clearly the better scenario to be in. No, it's not the better scenario at all, because here you can see the federal funds rate in blue against the yield curve in red. That's a 10-year minus the 2-year treasury yield. And what do you know? That what happens is the yield curve steepens as rates come down. Of course, we know as the curve steepens, that does not cause people to run out and borrow more money. It actually keeps the banks from lending, causes a further contraction in lending. And next thing you know, know, you're in a gray bar here. That signifies a recession, and we're headed into one, except this time, everybody's in this together around the world. And here you can see executive board member Isabel Schnabel has joined the Bundesbank president Joachim Nagel and other hawkish officials, and warning against lowering borrowing costs too soon, because that actually might make sense at this point by trimming into funds rates around the world, perhaps trying to uninvert these yield curves and money curves before disaster gets here. Even though at this point, even if they started cutting now, I think it's too late, because they're citing risks including sticky services inflation that won't last as manufacturing around the world continues to be in contraction, a resilient labor market. I'll make the case why that's about to go away too, and Red Sea tensions. That'll be the least of our problems, because here you can see continued claims in blue against the yield curve in red. Again, that's a 10-year minus the 2-year. And what do you know is when the curve steepens. And why does that steepen? Just want to remind you, because short-term rates start to fall. So keep in mind, as 2-year yields lead the 10-year lower in this case, of course, that means the Fed's going to be cutting. That is not good for the economy at all. In fact, you can see as the yield curve steepens, what happens to continued claims? They continue to head higher. And right now, everyone believes that if the Fed cuts rates a little bit, everything's okay. What this is suggesting is the yield curve is saying, no, it's too late. It's game over here. The labor market is the last shoe to drop before all-out chaos begins. But will central bankers react? No, not likely anytime soon, not until they face this worst-case scenario. As I told you, it was happening in a very big country. We'll get to that here in a moment, as Fed's Williams repeats rate cuts likely coming later this year. Because I want to make the point here, these central bankers are completely clueless about what they're doing. In fact, they're just flying by the seat of their pants most of the time. I expect us to cut interest rates later this year, he said on Thursday in a fireside chat at the Citizens Budget Commission's annual gala. We're going to move interest rates back to more normal levels, suggesting that they're too tight now. And that was validated by Metre, who says latest inflation data shows the Fed has more work to do because, well, we have to worry about inflation as our banks are hemorrhaging. I do think we'll see some moderation on the employment side. Well, we're going to see a lot of moderation on the employment side, depending on your definition of moderation, that is, Ms. Metre. And those are the conditions that we need to see to be able to assess, okay, the economy is evolving in the way we want. No, it's not. It's going to evolve in the way you don't want, because you don't understand what it is you've done to our economy and our money system here. If inflation expectations, year ahead inflation expectations, continue to move down, then I think we're in a good spot where we could consider an easing of the restricted level we're in, instead of saying based on the data in our economic models, we actually believe within a reasonable amount of fact that we will need a certain amount of cuts. Instead, she makes the case, as we've always said, there are no real models, continue to move down, then I think, not sure, that we're in a good spot where we could consider, well, that's all it's about. And here we can see this is what is coming for the U.S. economy. Is starting here in China now, as liquidity trap looms for China, as funding looks cheap everywhere. And what a liquidity trap is, it's when lower interest rates, easier monetary conditions do not lead to a turnaround and growth. It's exactly what's happening here in China now. With lack of confidence spurring consumers and corporates to hoard cash, it's raising concern among some analysts that monetary policy will fail to stimulate the economy. That is indeed the worst case scenario. Because you think about this, the U.S. economy continues to slow down, heads into recession. Banks start to fail. The Fed says, hey, you know what, we're going to fix this real quick. We're going to cut rates just like that to zero, like this Steve guy said we were going to do for the third time. Wait and see, it will happen. You'll be amazed. And then it does nothing. That is indeed what a liquidity trap is. And then what you get is the first signs of it. Loan growth sank to a record low. I made that case that if the Fed starts to cut, loan growth is going to continue to fall, even after the People's Bank of China cut its policy rate twice in the past year. That puts more focus on policymakers gathering next week for their annual parliamentary meetings. Real economic activity is increasingly not responsive to monetary injection. All we can say is that the risk of a liquidity trap is looming, As prices fall, households and corporates would choose to delay spending and save. That is, of course, the dangerous scenario here as we look at New York Community Bank, likely now the next bank to fail, perhaps either go into receivership or get bought out by another bank. We'll see how fast the Fed reacts as the new team there uncovers what is going to be not just a little bit of rot, but a lot of it, and an increasing amount as the economy continues to slow, putting us right on track for a liquidity trap where no matter how low the Fed cuts rates, they won't be able to save us. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.